Hello everyone, welcome back to a new video here on Nativitas. Today we're going to talk about the Alphabet Q2 earnings report. As you guys know, I own some shares of Alphabet, so I want to disclose that right off the bat. Additionally, we have another disclaimer here. That is, this is not investment advice or financial advice. Financial markets are volatile and unpredictable, therefore there is a serious risk of permanent loss of capital. Invest at your own risk. This video and others made by this creator, aka me, are not investment advice. I am not a licensed professional. It is recommended to contact a licensed financial professional before investing, and Nativitas is not responsible for any results of your actions. Now, what happened to Alphabet stock or Google stock, right? If we look at the share price here for Alphabet Inc. Class A shares, we see that the share price dropped tremendously, like a large amount. So what exactly happened? Well, first of all, we had a red day for the QQQ. Pretty much all tech stocks were down, quite a big amount too. I think Microsoft was down 3%, Meta was down something like 5% as well. Alphabet was down 5%, as you can see here, which is partly by just these natural financial market forces apparently, and also because of its quarterly report. So what did they report? Was it an enormously bad report, right? That's something we want to ask. Well, surely it couldn't be that terrible if it's only 5%, right? If you as a company show very terrible numbers during a quarterly report, then you would probably decline more than 5% or even 3%. I think aftermarket it was 3%. So what exactly happened? Well, the most important bullet points here are, don't mind, by the way, these pictures on the right, these mountainous pictures. I didn't pick them. It's just in the template of this PowerPoint. So overall, Alphabet beat expectations, except on YouTube ad revenue. That's just very important to note. EPS was 1.89 versus the 1.84 expected, which is the same as last quarter. But then again, last quarter's net income was also higher due to other income sources, which we'll discuss in the consolidated income statement later in this video. But basically 1.89 is very good. That's a very good EPS. Revenue stands at 84.74 versus 84.19 expected this quarter. So that's again a slight beat. It's not by much. It's a very minor slight beat. Now the YouTube ad revenue was 8.66 versus 8.93 expected. So that's slightly below what was expected. And that is the main culprit of this decline, because investors or Wall Street want YouTube to keep increasing. Of course, they want growth, which is understandable. I want growth as well. But YouTube ads revenue hasn't shown that growth this quarter. We might see it back again next quarter, or maybe next year, but this quarter the growth hasn't been as tremendous as they expected. It still grew, but it hasn't been as much as they wanted it to. Now cloud stands at 10.35 versus 10.20 expected, which is something I'm very, very happy with. Regarding Google, I think Google Cloud is by far right now their most promising business. It's not their most profitable, it's not their most revenue creating business segment, but in my opinion, it is by far right now one of the more important segments, because the pipeline basically where it's going to end up in 10 years is going to be very important. It's going to be, or at least they want it to be, this very profitable, very big segment of their business. And well, as we've seen this quarter, Google Cloud just continues to grow, and way, way above what Google or Alphabet overall grows. Cloud grew about 28% this quarter, or not this quarter, year over year, excuse me for that, year over year, and that is very, very good. That's just tremendous. We don't expect anything else from Cloud, by the way. 78% is pretty much what we're expecting from Google Cloud, but still, that is just insane. For a business with about 300 billion in revenue yearly, that is just insane. It's an insane number, and I think Google has to keep on working on Google Cloud, acquiring cybersecurity companies, investing in this capital that's needed, like data centers and GPUs and whatnot. What is needed to run these cloud centers, basically. So I like to see Google do that, and we're going to analyze that in the cash flow statement part. But as we're seeing right now, the quite hefty investments into capital expenditures into PPE, which is property, plants, and equipment, is definitely paying off. I'm curious to see what the growth numbers of Amazon and Microsoft look like. Usually Microsoft is on par with Google, and usually Amazon is quite slower. It's a slower grower compared to Google and Microsoft. So we'll have to see. We'll see that on the 30th and the 31st of July, which is basically next week. Traffic acquisition cost, aka TAC, was 13.39 versus 13.54 expected. Now, mind you, TAC is supposed to be lower, so it actually beat expectations in that regard. So what traffic acquisition costs are is just purely getting people to your platforms, like YouTube or Google search or whatever. So if those costs are lower, of course you're going to get more profit. So we want those costs to remain as low as possible, which Google has done, at least compared to expectations. So we're going to take a look at the report now. Now put the numbers in Excel a bit, so we could also compare it to Q1 of 2024, which is basically last quarter. And then if we look to the top line growth, we see that there's a good amount of growth in revenue, about 5%. And the bottom line grew, actually declined if you look at the net income, but that's the other income part that I was talking about. So if we look over here, we see that other income here is about 2.8 billion. While here it's only 126 million. Now 2.8 billion is way above average. That's way above average. 126 million is about normal. What 2.8 billion is way above average. So we're going to remove that part from the equation in just a bit here to see what actual net income was. What was the natural net income of this company? And then we're going to see that if we reduce 2.8 billion from the net income, of course we're going to see tremendous growth. We see 14% year-over-year revenue growth, which is quite a good amount of growth, especially for revenue. And Google search also grew 14% year-over-year. And this was something I myself was very curious about, because of course we could all say that ChatGPT is going to replace Google search, but we need to look at the data. I want to see, what does the data tell me, and does Google search actually get heard from ChatGPT? And pretty much the first indicator of that happening is revenue decline or revenue stagnation, right? And that didn't happen. We saw that last quarter as well. We saw that last fiscal year as well. Google search isn't getting hurt by ChatGPT. It's simply just not a substitute. So the whole Venn diagram, and I think Joseph Carlson was talking about that as well, the whole Venn diagram of use cases for Google search and ChatGPT, or generative AI for that matter, is completely different. There's a little bit of overlap, but the general use case is completely different. And that's of course very, very bullish for Google, because that was one of the main concerns, and that was one of the main factors suppressing the share price. Now you could already argue that that whole factor has been put back into the share price, so there's no real concern anymore of that happening, of Google search getting replaced. But I still think it's a very important thing to keep on looking at, because Google search continues to be the main part of Google's revenue and net income. So it's very important to keep an eye out for that, just to, if there's any decline, if there's any stagnation, that part of the business, the bottom line, but also the top line, basically all lines are gonna get hurt. Now if you just continue, you can see that year-over-year EPS growth on the bottom here was about 31% this quarter, and year-over-year net income growth was about 29% this quarter, which is slightly lower because they're buying back shares. So of course EPS is going to grow a little bit quicker than net income. But 30% growth is just tremendous. That's just insane. So what if we remove the other income part from this equation? Then we can see actually that net income grew quite a good amount. Net income grew about 13% quarter over quarter, which is really good, and 28%, about 28% year over year. Earnings per share, it came in about 1.88 if you remove other income, and earnings per share last quarter came in at 1.66 if you remove other income. So we can see that the numbers are just very good. They're just very good numbers. It's absolutely insane in my opinion. And I think it's not talked about enough if we're just looking at these numbers. What I think is that this company is doing tremendously well. But of course, back again, you see that in the share price. But what we saw, and that is why I'm saying this, is the share price. We saw a big decline. And the only culprit of that big decline is YouTube ad. And in my opinion, if we're looking at this is 300 million of lower income, right? Lower ad revenue, that is, by the way. It's not even net income, it's revenue. And even though that is a lot of money, of course, but for a corporation the size of Google, you can see it's just nothing. It's nothing. If you remove 300 million of this, and that is net income, if you remove 300 million here, we won't notice. You won't notice. You won't see it. Okay? You don't notice it here. Now, of course, it's all about the growth, and understand that part, right? You want to see the growth. But I think the decline is completely unjustified because all other numbers are very, very positive. So if you look at, indeed, the Google Cloud part of this business, I mean, Google Cloud shows strong growth and it's becoming very profitable. It's 2.5x basically year over year in terms of profitability. So I think it's completely unjustified to have a decline. But again, I'm a Google shareholder, so of course I think it's completely unjustified. I want to see the share price rise, right? So now if you go to the other parts of this business, I'm just going to go over here. I'm just going to take a look at the entire report. So we already looked at the main important parts. Now another thing I want to look at is the number of employees. Now Alphabet is infamous for hiring way too many people. Way too many people. And the business is still very large. It still has a lot of people. But we do see that they're addressing this matter. And it's slowly declining. So that's a good thing. That's something I like to see. Then we see at the operating income level, we see strong growth. Other bets is losing a little bit more money than before, but it could also be because of other factors like Waymo expanding business, and maybe those investments aren't going that well, right? Or maybe they're losing more money on that now because they're fueling up their growth, right? That could be. If you look at the balance sheet, there's one main thing I wanted to look at, and that is that the solvency has declined. And normally that's a bad thing. The current ratio went from 2.14 to 2.07. And that is something normally if current ratio declines, that's very bad. But if current ratio is above 2, that's too high. So going from 2.14 to 2.07 is something that I like to see. And where did that slight decline come from? Well, mainly from the sale of marketable securities. So Google sold quite a decent amount of marketable securities here, and they put that into PPE. So they bought up capital with the sale of marketable securities, basically transferring from current assets money into non-current assets, which is something I do like to see. I like to see the company invest into itself and trying to fuel that growth with extra data centers. And we can see that back again here on the cash flow statement. If we're looking at investing activities, we can see that the maturities and sales of marketable securities went up an enormous amount, about 15 billion. And what else went up? The PPE. They invested a lot of money into PPE. So we're seeing that a lot of that money is being transferred from marketable securities into property, plants, and equipment. Which is something I don't mind. I don't mind it at all. So I actually like to see the current ratio decline a little bit. But even with 2.07, I mean, the balance sheet looks very healthy. There's absolutely nothing you can complain about here. It's just a very healthy balance sheet. I would just like to see them invest maybe even more, but I understand that you need to do it gradually. So I like to see it decline slowly, and hopefully Google will someday approach into the range of 1.9 to about 2 in regards to current ratio. That's what I would like to see. And I mean, if they're not going to invest into Google Cloud, maybe they could use some of the money to buy back some more shares or whatever, so we'll have to see. If we look at the cash flow statement, and we look at, of course, and we already looked at the PP, but there's also some, at the investing activities here. But if there's also something new into the cash flow statement, which wasn't there before, and that is this line here, the dividend payments line. You can see they paid about 2.5 billion in dividends this quarter. And that is, of course, very nice to see. At least in regards if you're a dividend investor. We like dividends in that case. Now, Google doesn't pay out a large dividend. I think it's like 0.44% or whatever. So it's not large. But if you just look at 2.5 billion paid, right? And they had a total operating income or cash flow from operating activities of 2.6 billion, right? Reduce that by the net cash used in investing activities, we have about 2.3 billion, $23 billion left. I could see them increase dividend payments, right? Because if we also subtract basically that 20.8 billion, we're still left with about $2 billion, or basically this $2.7 billion in cash, right? And that is cash they could potentially use to increase dividend payments. If they did increase dividend payments with about, like 20%? With 20%, they would end up at about 3 billion. So that's a $500 million increase. And that would basically still mean they have 2.2 billion in increase of cash. So there's a lot of dividend growth perspective here. I would have liked them to see that. Would I like to see them do that? Well, not necessarily, right? I'm not a big dividend investor, but I'm just saying they could. I'm just saying that they could do it. Would I like them to see? Would I like it to see them do it? Not necessarily. I would rather have them invest into the business, into things like Google Cloud and whatnot. If they could, grow the business segments with that money. But again, if they can't do that, I would rather have them pay it out as dividends than buy up marketable securities, which is mainly government bonds, right? I don't want government bonds. I want my companies to do things that companies have to do, and that is not buying up government bonds. That's not something they should do, not something they should endeavor in. If I wanted government bonds, I would buy government bonds myself, but I don't want them, and thus I don't want my companies to buy them, right? So I'd rather have them than pay it out as dividends if they really do not know what they want to do with the money, or maybe repurchase extra stocks, right? Do some more share buybacks, also a possibility. So if we go back to my presentation, my PowerPoint, we see that free cash flow is down about 50% year over year, mainly due to additional investments in CapEx, which is those data centers. And then if we take a look at the current ratio, which was, it was 2.8 and 2.15. 2.08, sorry. So we can see that the current ratio is slowly declining, which is something I like to see. I hope they will bring it down to about 1.9. Between 1.9 and 2 is very good for a corporation like this. So I'd like to see that. Summary. Despite YouTube's underperformance, Alphabet shows strong revenue and net income growth. Further investments into capital shows the leadership is confident in Google Cloud's future, which has the possibility to turn very profitable in the future, which it already is. It's already pretty profitable, but it's possibly going to be even more profitable in the future. Overall, I think this was a strong quarter for Alphabet, and thus think that the share price unjustly declined. And now I'm going to repeat this part again, but I would just like to thank you guys for watching. If you found this video helpful, if you got any helpful insights from it at least, please like and subscribe. I'd really appreciate it. Thank you very much. Financial markets are volatile and unpredictable, therefore there is a serious risk of permanent loss of capital. Invest at your own risk. This video and others made by this creator are not investment advice. I am not a licensed professional. It is recommended to contact a licensed professional before investing. Nativitas is not responsible for any results of your actions.